Hey guys, welcome back. Patrick here. In this video, I'm going to tell you why the PSTH Universal Music Group deal is very disappointing for most investors, mostly my viewers, I would assume. But notice how I say most investors, not all of them. There are some investors out there where this is going to be a great deal. I'm going to break it down for you. And if you're in that category, you might want to pick up some shares while it's selling off right now. So let's get started. I hope this helps you. Please like and subscribe. It really helps the channel out. I'll see you right after the intro. Alright guys, let's talk about the transaction and why it's such a failure right now. So people had completely mismatched expectations compared to what Bill Ackman was looking for. So people were looking for companies like Starlink or Stripe that would have a lot of growth in the future, even though that's not exactly the type of investor that Bill Ackman is. He's the type of investor that looks for cash flow. So he invests in railroads and companies like those, and his annual return is about 17% if I recall, like compounded, even though he had an amazing year in 2020. Right, so that's the type of investor that he is. He's not the type of moonshot investor like Cathie Woods. So instead of getting like a Stripe, we are getting Universal Music Group and artists like Taylor Swift, Billie Eilish, The Weeknd, and the other ones. I mean, they are the biggest producer of music in the world. That doesn't mean that it's a bad deal. It just means that it is a bad deal for most of the investors that probably watch my channel. So if we look at the chart, I mean, you guys can clearly see as soon as it was reported in the Wall Street Journal that this was a big rumor, I mean, the stock really fell off a cliff to 21.75. There was a small rally, right, but on Friday it lost all of it. And it makes sense. It is not what people were looking for. And when you look at the details of the transaction, like, you can realize that, you know, the deal is worth about $20, $21. It wasn't worth 25 plus. So let's break this deal down based on if you own shares, warrants, and who is this deal actually good for? Who's going to be benefiting from this? So this by far is one of the most complicated SPAC transactions we've seen so far. They are going to be introducing a brand new structure called the SPARC, S-P-A-R-C, based around rights. Now there are other SPACs and other companies that have rights. I've never really invested in them, so that's not my area of expertise. I never talk about it on the channel, so you guys might want to look into it a little bit more. But basically, if you look at it, a right gives you the option of buying into their next deal, right? So that's what they had promised before. Bill Ackman said that if you were a shareholder in PSTH, it would give you the option of buying into the next deal at the IPO price. So I don't know if the IPO price is going to be $10, $20, doesn't really matter. The fact is you're going to be able to buy into it at the same price as one of the usual like pipe investors, right? So that's going to be pretty good. However, in general, the rights sell for less than warrants because the warrants give you up to 5 years in some cases to buy shares from the company. Very different from the rights. You guys can read a little bit more into it, but they're not worth as much as warrants. So this company is going to be split into three components. The first component, of course, is the main one. PSTH is going to be buying 10% shares of Universal Music Group from Vivendi for $4 billion, which values the company at 35 billion euros, which in US dollars is 42 billion, right? So this is a very big deal, and they are going to be listed in Amsterdam on the Euronext. This has a lot of implications for a lot of people, especially if you live in North America, right? So they're not going to be listed in NASDAQ, they're not going to be listed in the New York Stock Exchange, so the liquidity is going to be very different, right? They're not going to be in the same type of ETFs. So let's say the SPY, right, that tracks the S&P 500, well, it's probably never going to own this company. So that can be a pretty big deal. Also, another consideration you may want to look into is different brokerages are going to be struggling with this new structure, right? So a lot of the brokerages already don't let you own warrants. Well, now you'll have rights on top of that. Some of them are not going to let you even own the rights. So do contact your brokerage, see how they're going to be managing all of this. So if we look down, right, the $4 billion that they're going to be spending to purchase these 10% shares of the Universal Music Group amounts to $14.75 per PSTH share. So the company had a lot of money in their account. They have too much money, basically, so they're not going to be able to spend all of that on this deal. What that means is that you're going to have like the shares of UMG that are going to be redistributed to the PSTH shareholders on a pro rata basis, of course, and then you're going to have $5.25 left over in this entity called PSTH RemainCo, right? So this is not going to be a typical SPAC. They're not going to have the 2 years to do a deal, right? So it's kind of like a new entity, but kind of different, like a different company altogether that's not considered a SPAC. So that's the second part of it. And then you're also going to get those rights in Pershing Square Spark Holdings, which is going to be listed as SPARC. And again, that is going to allow you to buy shares of the new deal when they find one. So these rights, you're going to be able to trade them if your brokerage allows you to, right? But they're going to be worth a little bit less than the warrants typically are. All right, now let's get into the warrants, and this is extremely important. So please pay attention, especially if you already own warrants. Every single time something like this happens, we have people that don't redeem them and then they expire worthless. So if you have warrants, this is for you. All right, so the way this is going to work is if you have warrants in the company, they are going to do cashless exercise. So, you know, usually when you have a SPAC after the merger, after 30 days, you can exercise your warrants for shares. And if you don't, often at some point in the future, the company is going to call them due and trade them either for $11.50 or they're going to give you a proportional amount of shares based on the number of warrants you have. Well, this is exactly what's happening with PSTH. Since they're just going to redistribute the UMG shares, there's not going to be a close like we've seen with other SPACs. They are going to do a cashless redemption for these warrants. So they are talking about it right here, if you guys want to look at the press release, and they're referencing the proportion of shares that you're going to get as being on page 166 of the prospectus for PSTH. All right, I looked at it. Maybe there are different versions on page 166. I'm personally not really seeing it. So what I think is happening, and you guys may want to correct me if I'm wrong, is they're going to be using this one, which we've seen with a lot of the other SPACs, which is fair market value of Class A common stock, which is basically the table based on their cashless conversion with all of the strike prices and also the time periods. So if I understand this correctly, let's say that the share price currently is at $22 and the transaction is not concluded, so we'll use 60 months time period. Well, we would get 0.2586 shares per warrant owned, meaning every 4 warrants that you own would give you 1 share of PSTH, which would eventually become 1 share of UMG plus PSTH RemainCo. I hope that makes sense. You are going to want to really follow this very closely, and when they make you, like when they call these due, I don't know if they're going to do it automatically like they did with the units. For this company, the units were split automatically. PSTH is very good at doing that. However, if they don't, you may need to contact your broker and make sure that they actually do this redemption so you do get your shares of PSTH. Every time like companies call them due, there's always people that don't, like between 1% and 5%, and then they expire worthless. So do pay attention to that. Now, if you do 0.2586 of $22, you're going to get about $5.50, right? Well, right now, the warrants are worth 5.62. So it's pretty much like where they should be based on this conversion. So I'm pretty sure I'm correct on this. But again, if I made a mistake, you guys can correct me. But right now, there's no big arbitrage opportunities from owning the warrants that I can tell. All right, so let's talk about why this deal is very disappointing to most investors and why the price is falling. So it is very easy to understand. Most people that watch YouTube videos are in a certain age group. The analytics show that most viewers are between 20 and 55, right? So whether you're older and younger, I hope you find value in my videos. I like everyone, but it's just a fact that most viewers are in that age group. And when you're between 20 and 55, you are in wealth building mode. You want your portfolio in growth mode, not in wealth preservation mode. So it is very different, right? So when you're between 20 and 55, you want a lot of growth. You're looking for for companies like Tesla, Palantir, companies like Rocket Mortgage, in my case TTCF, companies that can grow 50% per year, 100% per year, or on the low end, companies like Facebook at 30% per year. Right? Those are the type of companies that is going to help you build your wealth rapidly over the next decade or two. Now, it's very different if you're 55, 65, getting closer to retirement. Now you want to lower your risk because you don't want to lose your wealth, right? And often what people will do is they go into companies that are a little bit safer, right? That are going to grow 10% per year, give a dividend of 2-4%, kind of like Utz, right? So you guys remember my opinion on Utz. It did a lot better than I suspected, right? It went much higher, but it is that type of company that is going to be Universal Music Group. It is going to grow, but not that quickly, right? They're going to give that little dividend and they're going to get some growth every year, but you're not going to get those 40, 50 plus percent plus growth per year. So that is why it is disappointing. People were looking for companies like Starlink, which was never going to happen, but companies like Stripe would have been really, really good for a growth-oriented portfolio, getting in like at the IPO price. So that is why it is very disappointing. Now, that doesn't mean it's not a good deal, right? If you are a little bit older or you don't have as much risk tolerance, if you're more of a passive investor, that you're just sticking it in your IRA and you're going to leave it in there for 20 years, then this is a pretty good deal. There's nothing wrong with it, especially when you consider the dividend, right? I would much rather buy this company and collect that dividend, since they're also going to grow a little bit, than invest in, let's say, like a just pure dividend play like Coca-Cola and get 4% or something like that, right? So with this company, you are still going to see some growth. Now, here's another problem with it that I have, is that they have really saturated the market in Europe and North America. Most of their revenues now come from streaming. 10 years ago, they were mostly from people buying CDs and stuff like that. Now, everything is about streaming online on Spotify, Pandora, companies like those, right? All the biggest artists, Taylor Swift, Billie Eilish, a lot of them are with UMG, and every time you play their song on Spotify, they are going to collect a little bit of money. So the company has been really, really profitable because of that in the past few years. But here's the thing, is that they already own that market. Now their next phase of growth is in Asia, and we don't really know if that's going to be as successful, right? When you look at the numbers, you're going to understand exactly what I'm talking about. This is the first quarter for Universal Music Group. They generated in 2021 1.8 billion euros in revenue. That's exactly what Bill Ackman was looking for. A company with a lot of revenues that is going to be generating free cash flow. The problem is when you compare it with the first quarter of 2020 at 1.76 billion euros in revenues, well, you get an increase of only 2.2%. That is anemic growth, right? So if you're a growth investor, this is terrible for you. And that's why the shares are tanking right now. All right, so if you go for the full year 2019 versus 2020, you're going to see that Universal Music Group only went up 3.8%. So it wasn't just a bad quarter in the first quarter of 2021. It's just the company doesn't grow very quickly. The only positive that I can find is that their profitability is actually going up, right? So if you look at the income, it went up 18% year over year in 2019 to 2020. I would assume because streaming is actually much more profitable. There's less costs than, like, I don't know what the other breakdown of their revenues. I don't know if touring is part of that, right? But streaming is just very profitable for them. The margin is very good. All right, so that's basically it, right? The company is going to be more profitable now than it was before, and they are going to be redistributing all of that cash to the shareholders in general as a dividend. So last year they gave 0.6. The year before was 0.5, 0.45, 0.4, so you can see that since 2017, they had been steadily increasing the dividend, and I don't see that changing anytime soon. So if you're a dividend investor, this deal may be good for you, right? But if you're a growth investor, it's just not that good. All right, guys, so in the wrap up to the video, there is one last thing we need to talk about, and that is, we know what we're getting with Universal Music Group. For us, it's probably not the best, and I'm glad I sold my shares before the drop. However, there is still like a question about what's going to happen with PSTH RemainCo. They still have 1.5 billion to invest in another company. So this is going to really open the door for them to get something like a little bit more aggressive when it comes to growth, because since they're going to have less money to spend, strangely enough, that gives them way more options for the companies that they can merge with. Remember, we had talked about this before. The company had so much money that like the list of potential companies they could merge with was only like 100, maybe 200. Well, now that you lower that to 1.5 billion, they actually have way more options. So maybe they'll go with something that is a little bit more aggressive when it comes to growth. So, you know, if you want to invest in this company, if you already have shares and you haven't sold yet, maybe you can roll the dice and see if they land something good with PSTH RemainCo. You're also going to get the rights to their next deal. So it's up to you, but personally, I'm happy I sold the shares, and I probably won't be buying into the company. I'm just going to get a couple of shares from my warrants being converted to PSTH and then the UMG shares. Guys, let me know in the comments what you think. Do you like this deal? Let me know. I mean, I want to have your opinion, and I'll see you guys in the next video.